We are continuing our discussion of Chapter 1, the Financial Reporting Environment. This is Part 3. The issuance of new standards and changes in existing standards can have significant effects on any entity's reported net income. In turn, these income effects impact the flow of capital throughout the economy. Now, at the company level, managers, they have incentives to oppose changes in standards or new standards that reduce their company's reported net earnings. On the financial statement user level, a new standard or a change in existing standards should provide better and more transparent financial information that will assist users in making more effective investment and credit decisions. Standard setters address the concerns of both managers and financial statement users by employing the standard setting processes described in our previous sections. Now, these processes, they rely on information gathered and opinions of users, managers, and auditors, along with comments obtained from responses to exposure drafts and public roundtables. The standard setting bodies analyze this information to gauge the economic consequences of the proposed standard and to assess the improvements in the quality of the financial information disseminated to the market. Standard setters, they address this trade-off between the income effects and the value of information, of financial information, reaching a balance before issuing the final standard. So here we are at the end of Objective 3, which was to detail the standard setting process. So the question is, what is the accounting standards codification? What is the accounting standards codification? The accounting standards codification is the single source of GAAP in the US. It's a single source of GAAP, and it includes all the pronouncements issued by any of the standard setting bodies that have not been superseded. The FASB currently issues accounting standards updates as part of the accounting standards codification. And we'll go into learning objective 4, which is explain 3 recent trends in standard setting, principle-based, rules-based, and objectives-oriented standards, the asset liability approach, and fair value measurement. Okay, so we're going to conclude this chapter by introducing 3 current trends in standard setting that we will explore further in later chapters. They are a move toward a less rules-based or a more principle-based system as found in international financial reporting standards. The second, a move toward standards that are focused on the asset liability approach. And third, a move toward measuring balance sheet items at fair value rather than historical cost. So what are these 3 standard settings that we're talking about? The current trends in standard settings. Again, principle-based standard, rules-based standard, and objectives-oriented standard. Both of the US GAAP and the IFRS systems of accounting standards are based on principles and rules. We know that, right? So a principle-based standard relies on theories. They rely on concepts. They rely on principles of accounting that are linked to a well-developed theoretical framework. A rule-based standard contains specific prescriptive procedures rather than relying on a consistent theoretical framework. For example, assume that your parents say you must maintain a GPA of at least 3.0. You must maintain a GPA of at least 3.0 to receive a car at graduation. Now, this is considered a rule base. Now, assume that your parents tell you that they will buy you a new car at graduation if you do well in school. Now, that example is an example of principle-based standard. The SEC uses the term objectives-oriented standard to refer to a standard that is somewhere in between, somewhere in the middle. It's in between a pure principle-based standard and a pure rule-based standard. Pure principles-based standards exhibit the following characteristics. They provide a clear discussion of the accounting objective related to the standard. It involves few, if any, exceptions, and involve no test that requires meeting a pre-established numerical threshold. Provide insufficient guidance to implement the standard. It involves a significant amount of interpretation and application. So with pure principles-based standard, comparability across entities is often lost due to the extensive amount of preparer judgment required. In other words, with principle-based standard, it could be very time-consuming because it's going to involve the preparer's judgment, and it's going to involve a lot of research. So in addition, preparers and auditors, they worry that regulators will not support the judgment used when reporting under a principle-based system. Even judgments made honestly without intent to bias. Finally, the lack of application guidance can make it difficult to enforce principle-based reporting requirements in practice. Unlike principle-based standards, the rule-based standards may not relate to a consistent theoretical framework. In addition, pure rule-based standards contain numerous exceptions to the types of firms and industries that are covered by the standard. It contains numerous bright line tests. It results in inconsistencies between standards. It contains detailed application guidance, and it do not rely on extensive use of professional judgment. So as in this case, with pure principle-based standards, pure rule-based standards also result in implementation problems. And you can see why. Because at times, reporting entities may circumvent rules and are therefore able to override the intent of the standard. A system of rule-based standard is difficult to interpret from a user perspective. Rules-based standards tend to result in an environment where financial reporting is viewed as an act of compliance rather than a process of disseminating transparent financial information to investors and creditors. A sorry, a SEC report studying rule-based and principle-based standard setting indicated that an objective-oriented standard is optimal. Similar to principle-based standards, objective-oriented standards are derived from and are consistent with a high-quality theoretical framework and clearly stated accounting objectives. However, objectives-oriented standards include a sufficient level of rules to provide detail and structure, resulting in the consistent application of accounting standards across entities and across time. An objectives-oriented standard would minimize exceptions to a particular standard and also reduce the number of bright line tests used in its implementation. Many of the existing standards in both US GAAP and IFRS qualify as objectives-oriented standards. Now, neither GAAP nor IFRS fits perfectly into a rule or principle-based approach. Neither one of them. However, the greatest difference between the two standards is that US GAAP contains many more rules than does the IFRS. Now, although the US GAAP includes more rules than IFRS, it is not purely rule-based. Similarly, the IFRS-based standards on their the US GAAP and the IFRS-based standards on their respective conceptual framework, which we'll discuss later in chapter 2. Neither US GAAP or IFRS fits perfectly into a rules or principle-based approach. Neither one of them fit perfectly. However, the greatest difference between the two standards is that the US GAAP contains many more rules than IFRS. Now, although the US GAAP includes more rules than the IFRS, it is not purely rule-based. Similarly, the IFRS is not purely principle-based. But both the US GAAP and the IFRS, they base standards on their respective conceptual frameworks. And we're going to discuss that in chapter 2. So if you look at Exhibit 1.10, it shows the placement of US GAAP and IFRS standards on the rule-based and principle-based continuum. The next trend relates to the interrelationship between the balance sheet and income statement. When a firm reports an event on the income statement, the transaction typically also changes a balance sheet account, right? For example, if a firm reports revenue, it also increases the balance in accounts receivable or cash. Now, while the two financial statements are interrelated, which set of accounts is dominant? The revenues and expenses on the income statement, or assets and liabilities on the balance sheet. Now, which set of accounts is dominant? Okay, here's an example. In a typical sales transaction, an accountant will increase accounts receivable and revenue, right? In a typical sales transaction, an accountant will increase accounts receivable and revenue. But how does the accountant decide whether to record the transaction? How does the accountant decide whether to record the transaction? Well, recording based on revenue recognition criteria involves an income statement approach. Recording based on revenue recognition criteria involves an income statement approach. Now, basing the decision on whether an economic resource is received and it meets the definition of an asset, such as accounts receivable, is an asset liability balance sheet approach. So basing the decision on whether an economic resource is received and it meets the definition of an asset, such as accounts receivable, is an asset liability balance sheet approach. In FASB's early years, it tended to focus on an income statement approach. However, in recent years, it has shifted. It's shifted to an asset liability approach. Another trend in standard setting is the movement toward the use of fair value measurement as a viable alternative to historical cost. Now, fair value, it is the amount at which an asset or a liability could be bought or incurred or sold or settled in a current transaction between willing parties. 20 years ago, firms reported very few items on the balance sheet at fair value. However, today, firms use fair values to measure some balance sheet accounts. Firms use fair values to measure some balance sheet accounts. For example, firms must report some investment in equity securities that have a readily available market value and some investments in debt at fair value as opposed to historical cost. We will discuss fair value measurements more extensively in Chapter 2.